everybody in. We'd just like to welcome you all to the Q2 2026 market review. You got myself, Joe Maas, and Tim Nyland. We're going to walk you through what we're seeing, what we're doing, and kind of have some fun. So, starting off, this is just a great quarterly review. What a quarter, right? I always love to do the quarterly state of the markets when there's been a positive quarter and things have been looking good, and people are happy, as opposed to when the quarters have been rough and everyone's grumpy. So this was a nice quarter. As you can see, the S&P 500 total return was up just a little bit over 15%. The tech, that was really the darling of the quarter. You can see 27.7% on the NASDAQ 100. And then bonds really kind of maintained, a nice yield for investors. But in the red, this is the interesting part. This is gold and silver. And so if you've been listening to our market updates over the years, you know that we always kind of think about offense and defense, right? Like a football team, there's the offensive squad, and their job is to go score. And the defense, they come on the field to prevent the other team from scoring. And so the cycles work that we do in the market is kind of like that, right? Tim and I are building portfolios, and our team are building and adjusting portfolios. As we go through the cycles, there's sometimes that we're putting the offense on the team. There's sometimes we're putting the defense on the team. And sometimes the defense is doing the scoring, right? Like in 2022, the way to make return was in the defensive sector. So sometimes the defense can be that top scoring defense. And well, as you know, that some players only play offense and some players only play defense. And, over the years, you'll hear us talking about metals, kind of a unique asset class where sometimes they play offense and sometimes they play defense, right? So there can be a flight to quality, or there can be a speculation. So some people use metals and gold to speculate, and some people use them to hedge. And so over the last year or so, we've seen these metals performing very well, really taking their place as an offensive player, right? Providing great returns. And this quarter, that script flipped. And so this last quarter, we see that they went on, they're down. So they kind of decoupled from the risk on assets. And, we'd seen in the past, they were really correlated with risk on assets. But last quarter, they actually decoupled. And we saw the negative correlation come back between these metals and these equities. So, Tim, I don't know if you want to mention anything there. I just wanted to point that out that, we do like to kind of pay attention to metals. Are they being in an offensive, or defensive posturing? And, last quarter, we did see this, quite significant divergence between an up 15 and a down 14 or a down 22. So,
yeah. And the metals are just really interesting because the bulk of them, if not all of them, are denominated in US dollars. So, dollar strength, dollar weakness will impact the pricing there as does, their responsiveness to interest rates. So there's a lot at play there, but, that's really all I have to add, Joe. Thank you.
Yeah, so great. So moving on, what we're going to see here, this is just kind of the 12 topics we're going to go over. We're going to kind of look at, in general, what happened, where we're at, and where we're going. So we'll kind of look at the past, the present, and the future, and we'll try to get through these 12 topics as fast as possible. So starting off, we're going to see on the next slide here that there was really three major themes that we were paying attention to and that we thought were influential in the markets last quarter, and that was the U.S.-Iran ceasefire, the tech rally, and then the inflation resurgence. So Tim, you want to walk us through and tell the audience kind of what our team of analysts and what we're seeing here?
Absolutely. So we had a ceasefire that got announced back in April, and that obviously triggered quite a reversal across global markets. So you recall from Q1, we had quite a correction in Q1, and the U.S.-Iran ceasefire was predominantly the reason for the rebound that we experienced in Q2. So we obviously had the Brent crude collapse. We had basically the tech rally reignited, right? So in Q2, we saw semiconductors just absolutely rip. And the Philadelphia Semiconductor Index posted an 88% gain for the quarter. And year to date, the semiconductors themselves have been the predominant driver of the S&P returns. So again, the NASDAQ 100 surging 27% for basically its best quarters in years. And in a couple slides, you'll see that that theme actually played out globally, right? We had Japan posting, the best quarter it's ever had. We've had other regional indexes also perform the best quarter they've had in years. So it's been huge, right? So, also keep in mind that in the quarter, we went through Q1 earnings season, right? And 83% of S&P 500 companies actually beat their earnings estimates. So on top of the Iran ceasefire, we had that momentum of earnings growth. And then throughout Q2, we actually had estimates continue to rise, right? To the point now where we're seeing that we're going to have another really, really strong earnings season that literally just kicked off yesterday. We are starting to see a little bit of consolidation here in June, and that's absolutely normal for the size of a rebound that we had here to start off Q2. And we're expecting that consolidation to kind of continue to be a little bit rough through the midterms. And then we'll talk about some additional factors that will influence this going forward. But throughout the remainder of the year, we expect a pretty solid close to the second half, barring any black swan events or anything like that. The last item that obviously the team we pay close attention to is what's going on with inflation, and that was certainly something that we discussed in our last conference call, and the inflation resurgence accelerated as we expected and as we discussed. Interestingly enough, it did spark a hawkish Fed response from the new Fed chair, Warsh. But recently, as of this week, we've actually had some pretty positive, CPI reads as well as PPI this morning that have actually pushed the likelihood of a Fed rate hike, back for us for this year. So that's actually good news. So that's really the quarter at a glance. And again, super strong quarter.
Quick things here. One, you're going to see a couple themes today. One, you're going to see earnings as a theme throughout this presentation. You're also going to see that, when oil goes from 110 to 72, you're going to see the commodities really went down. So you're going to see some themes there. And then the other one that Tim is really a master at and has been writing and talking about and beating his chest on for years before the markets even paid attention to it is that private credit. Now, we don't have private credit on this slide directly, but you will notice on that the third bullet point under the Iran ceasefire, we do have the high yield CC spreads past the 900 basis points. So we are seeing that bottom end of that high yield credit, and that can kind of flow over maybe into the private credit. So that we are still watching that, and that is something that most people aren't paying attention to, but we are watching that high yield and that lower end of that curve. So. Anything else update on private credit, Tim, that we have?
No, I mean, we've seen some redemption gates go up again, Blue Owl and others, but nothing, out of the ordinary. We've been seeing this trend playing out now for probably a year, and we just keep a pulse on it. But certainly that high yield, the triple C spread divergence at 900 bips is a true divergence because overall high yield credit spreads remain historically tight. So when you start to see this sort of thing break out, it's kind of like what we call a canary in the coal mine. It's kind of an indicator. It's a pulse, and it's something that we pay attention to. So that's a good point, Joe. Thank you.
No, absolutely. Okay. So here, this is a nice quick slide. You'll see that we're looking at some of the broader indexes, the S&P, the NASDAQ, Dow Jones, and the Russell. And you can see that the S&P had those first two quarters were up. And then, months. And then we had, June was down there in the NASDAQ as well. But the Dow Jones and Russell had three strong months. And again, the returns speak for themselves at 15% on the S&P and 27 on the NASDAQ, 13 on the Dow Jones, 21, plus 21 on the NASDAQ. Everyone's at the party in this equity space last quarter. Tim, this is a fun chart. It's just kind of the same data that we showed on the prior chart, but it's kind of fun to see the progression throughout the quarter. We had that April rally, we had the May rally, right? And then we did have some pullback in the S&P and during the last month of the quarter, but we did reach an all-time intraday high of 76.21 back on June 2nd. So that was really fun to see. And then there's the consolidation from that point going forward. So Tim, you want to talk about that June consolidation coming off that high and how we ended up there at,
Yeah, absolutely. So this chart is really unique because we're really taking each Friday close weekend price level for the S&P 500. So just trying to smooth it out a little bit, cut out some of the noise so that you really kind of focus more on the overall trend here. And what you're seeing with the June consolidation is very, very healthy for the markets going forward after we had such a strong April and May recovery period. So this is actually something that we want to see. And it's also healthy going into the midterm elections where we're experiencing some volatility anyway. So you think about this as just kind of like a coiled up spring, okay? Think about this, right? We have this period of June consolidation. We're expecting the market to be choppy and continue to consolidate right into the midterms. But what's happening during this time, right? Companies are reporting, right? The sell side banks, the analysts, and everybody, the companies are guiding. And then in turn, if the earnings results for the quarter are positive, right, they're going to continue to revise estimates up. And so we continue to get this pressure on valuations. And that's why we believe that the second half after the midterms of the year, the second half could be, in fact, very strong. We could get a nice year-end type rally here. So you think about this consolidation period as healthy. It flushes out the market, and you continue to grow your earnings beneath, and it builds pressure for the market to continue to rise.
Yeah, and I think we overlay the Fed, the new Fed chairman, and the debate. On Bloomberg this morning, there's people calling for them to raise rates faster, and some want them to, the probability of rates, being raised or going down. So the market is going to really test the new Fed chairman. The new Fed chairman is going to learn how to drive this economy, right? Very smart, intelligent, capable person, but until you've done it, you haven't done it. So there's, we expect this consolidation. We expect some volatility between now and the midterms. That would be natural, but we already have a great. If the year ended today, everyone would be happy with that return. So you think about it this way, if the market even pulled back half from where it's at, you're still up 7.5% for the year. So we can't have high double-digit returns 3, 4, 5 years in a row. That's just not healthy. Things can't go up forever. They have to pause. They have to take a breather. There has to be a half a step back to go forward. So we're seeing this consolidation. There's a lot of turbulence that we're going to see. We throw in the geopolitical risks of the Iran ceasefire, which is on and off and on and off. So although we'll show you that the geopolitical stage has been very calm when it comes to the VIX as measuring volatility, there's still a lot of things out there that are going to cause this pause is normal. There's nothing wrong with that, and so we're paying attention to that, and we'll keep you posted. Now, last quarter, it wasn't just the U.S. that was having a party. Here we're going to see that the Nikkei 2225 is up 37%. So the world stage was participating, right? You have almost 12% in Europe, Canada, the emerging markets, right? And then Great Britain had a positive quarter, and normally a 4% quarter people would be very, very happy with. That'd be a 16% annual return. But when you look at these other high double digits, it doesn't look as good. It doesn't look as strong. But Tim likes to point out that this index is made up more of some defensive names and some value-oriented index. And so, not all indexes are apples to apples. So you can't just look at the U.S. going, oh, wow, look how much better the U.S. is than Great Britain. You really have to look at the constituents in the indexes to see what they're made up with and understand them. So we don't need to get in all that minutia, but it is nice to see that the equity returns, it was a risk on equity party for the quarter, both in the U.S. and globally. Tim, anything else you want to add there?
Yeah, the only thing I do want to add is that just to let everyone know that, when we're building out our models and we're rebalancing portfolios and we're doing all of our work that we do every day, we spend a lot of time on the constructs of the indices, right down to the underlying members, how the actual math, right, is constructs the indices, how they're weighted, the whole 9 yards, so that we understand what's at play here. And you can see that on the slide for the FTSE, as Joe mentioned, right? Lagging its EU peers, defensive value-oriented index. So just to share a little bit of that with you, most people don't realize that there's a lot of analysis that goes into the actual indices themselves.
Yeah, and I think on the flip side to the FTSE 100 is the Nikkei, right? Because you can see that is full of tech companies, right? And so that's where the returns are coming from, which you'll see and continue to see. So that is the other end of the spectrum, and that index was the highest because of what's in that index. So
yeah.
Okay. Now we're moving to asset classes, right? So we looked at indexes in the global regional stage. And so here we can see that, again, tech was at the top, and then we had small caps, then the S&P 500, international developed, real estate, high yield, T-bills, and U.S. bonds. And then there is our commodities and gold that we started talking off at the top of the show here. So, commodities were down, and that's very normal. There's nothing alarming there. That's really good, right? Because when commodities go down, inflation goes down. Commodities are the root of inflation. So when oil went from, what was it, 110 down to the 70s, that's a negative return. And so you can see that the 11% or almost 12% negative return on commodities is very natural. It's explainable. It's understandable. And then gold, again, that rotation in away from that risk of that asset class acting as a risk on asset class. Very, very understandable why gold was down there, almost 13% for the quarter. So again, broad participation across the globe, across sectors and across asset classes in that second quarter. Here we're going down to sectors. Tim, you want to walk us through the last? I think this is probably our last layer is actually going down to the sector level.
Mm-hmm.
And
Yes, so these are the actual sector ETF total returns for each of the S&P 500 sectors, right? And you can see the very first one there is called the XLK. So you've got all the ticker symbols there on the left of that table. And you can see the tech sector up 43.5%. And again, believe it or not, this was not necessarily driven by the Mag 7, but it was driven by semiconductor names. And that's an important distinction. We're going to talk a little bit more about that here in a few minutes. You can see the S&P 500, again, up 15.2, followed by industrials, financials, healthcare, real estate. And in a few slides, we're actually going to talk a little bit about sentiment. Joe put together a really neat slide on how sentiment shifts took place throughout the quarter. So we keep an eye on that as well. But this quarter, we just had a super, super solid participation across most sectors. And again, just to reinforce what Joe said, utilities, comm services, energy sectors, they just didn't participate as much. And obviously energy with the crude oil collapse and pricing was really the driver there. So
yeah, you can see, there's defense. We go back to offense and defense, right? Some of these sectors play offense, some of these sectors play defense, and sometimes they kind of play both ways. So we can definitely see utilities and energies down there. We do see some of the the defensive sectors that did well in the healthcare, but you can see a little bit of divergence between these offensive and defensive sectors.
One comment I want to make before we move off this slide is that we do pay quite a bit of attention to the underlying constructs of each of these sector ETFs as well. And one of the important points there with comm services being down 3.1, while tech was up 43.5. Keep in mind, comm services has roughly, you could almost say upwards of like a 50% weight in Meta and Google alone, right? So it's really the pulse of those two companies that comm services represents. And so Meta was actually one of the names of the Mag 7 names that was down for the quarter, which is really what drove that number to be negative 3.1%. So again, we lift the hood on these things. We pay attention to what's going on. We're actually going to present some of the Mag 7 performance here in just a minute to get to see it.
Yeah, that's a really good point, Tim, that a lot of people think that Meta is in the tech, information tech, and not in comm services. And so again, understanding what's in each sector sometimes is interesting, or it's always interesting. So yeah,
absolutely.
Okay. All right, this is always a fun slide. We do a we do a lot of work on an everyday basis that you just don't see. And one of the pieces that we put together is our market cycle work. And we're looking at a whole bunch of factors, and we're just trying to determine if we think they're bullish or bearish. And so as at the end of the quarter, we're kind of 75% bullish and 25% bearish. And so we'll walk you through some of these factors that have contributed to this. So Tim, I'll take the first one that I think is kind of is contrarian down there, and that's on the bear side. I'm going to talk about the recession risk over the next 12 months.
Yeah.
And so the Bloomberg consensus is coming in about 25% that there'll be a recession over the next 12 months. So why do we put this over on the bear factors? Because sometimes economic news is contrarian, right? When you get too bullish, it's actually bearish, and when you're bearish, it's bullish. And so here, there's a lot of moving parts that could lead us into seeing that recession risk go up a lot higher. So although the number itself says 25% over the next 12 months, we could see this number increase very rapidly with all the irons in the fire. And so we put it over there just to show a contrarian position that there's some risks that we're watching. But if you just looked at the number in of itself, it would be on the bull side.
Good point. All right, I'll take AI CapEx spending or capital spending for fiscal 2026. And I'm actually going to comment on this relative to a question that I just saw come across the screen about what our exposure is in AI. And that was actually a really, really good question. And this AI CapEx point on the bull side is a great opportunity to speak to that. So that increase through the quarter from 650 billion for fiscal year 2026 to 870 billion was the most recent revision that we had prior to building out the slide deck. And that actually came from B of A Research. And I have an update for you on the most recent estimate that just came out this morning for 2027 and 2028 was from Morgan Stanley. And that 870 is expected to rise to 1.2 trillion in 2027 and 1.4 trillion in 2028. Those are staggering numbers. That's trillion with a T, okay, up from 870 billion with a B. Now, regarding the question about what our AI exposure is, remember that AI, it basically it envelops many industries. And if you think about the fact that all companies are now embracing AI, you could pretty much say that across all of our equity portfolios, we're getting some participation somewhere. Even companies like C.H. Robinson, trucking and logistics companies are embracing AI. They're raising margins, okay? They're using it to provide operating leverage in their corporations to drive down prices and boost efficiencies. But specifically, what are our exposures to AI? Let's think about this from a couple different perspectives, right? Obviously, the most obvious are the hyperscalers. That's what you hear all about. That's your Meta, your Amazon, your Google, those sort of companies. But believe it or not, we have a lot of component type hardware companies that go into providing the semiconductors or the chips that go into creating the hardware environment that allows those hyperscalers to build out those large language models and do everything that AI does. And so many don't realize this though, but there's a huge difference between, you hear about Taiwan Semiconductor all the time. A Taiwan Semiconductor is not a semiconductor designer. They're a manufacturer, right? So when you think about semiconductor design, think about NVIDIA, think about AMD, right? Taiwan Semiconductor then makes semiconductor chips for those types of companies. They're the manufacturer. So we have foundry companies, they're called foundry companies. Then we also have all of the components that supply the semiconductor manufacturers, right? So that would be like your ASML, that would be, Marvell, it would be all the software testing companies. So there's a myriad of touch points across a multitude of our portfolios that are exposed to AI. So that's why we keep such a tight pulse weekly market cycle. We present this at quarter end, and you're going to see AI CapEx spending on the scorecard for probably many quarters to come because of that. Because you think about like an octopus, it just has tentacles everywhere, literally throughout the economy and throughout our portfolios.
Yeah. And I want to point out something. AI guys, you guys have probably known AI since ChatGPT, right? The world's calling AI ChatGPT. AI has been around since the 90s. AI has been around for 30 years, okay? You just didn't know it. So machine learning, neural networks, HMM models, a lot of the math statistics that are used in AI have been around forever. So like Tim said, let's take Meta or Amazon. They're an AI company. You knew them as a book company 20 years ago. And so AI has really been around. It's just really being redefined. So people use AI very loosely. And like Tim was showing you, there's so many different facets of it. And then even what I'm kind of like a little more concerned with sometimes is the peripheral, because you need energy. You need capacity, you need storage, right? So there's debates where Musk's going to put all the storage in space, or there's not in my backyard. You might have heard that. People don't want all these very large data centers that consume a lot of energy in their backyard. Down in Phoenix, we have a lot. There's in Eastern Washington, there's a lot. So, there's so much more to this AI story than what you get out of the headlines. And so we shouldn't just say AI. You really need to be very specific when saying AI is what do you mean by AI? But AI, as I think the audience thinks of AI as Claude and ChatGPT, it's not going away, okay? It's not a flash. It's not a bubble. Now, there's going to be winners and there's going to be losers, and valuations are going to get ahead of themselves and they're going to pull back. That's all normal and healthy, and that's what markets do. But AI isn't going away, and it's much, much more than just ChatGPT. So we're going to, like Tim said, we're going to have exposures to it all over the portfolios. Some are going to be energy. Some are going to be in the focused digital portfolios, right? Some are going to be in dividend portfolios. So it's really throughout the economy. And so it's a very exciting space. And again, when you look at how much money is going to be spent, trillions of dollars, that's not just on NVIDIA, on chips, or just on, OpenAI or something. It really, like, what did you say? The tentacles go deep. So
they go deep. They go deep.
Yeah, and I think a really interesting point that we have we were trying to follow some best practices with PowerPoint, and so we put a lot of things in 8-point fonts, so you can't really read them. We apologize for that. But anyway, you can see there that it contributed to 1.4% of real GDP growth, and we'll talk more about that. So it is an important area. And it is going to be throughout the portfolios. And again, sometimes you're going to look at a company and you're not going to really think it's an AI company, but it's supporting the network of AI. So very exciting there. I mean, we could talk about that for the next hour, right, Tim?
Yeah,
so
absolutely.
Yeah.
Yeah.
I know Tim's going to talk about corporate earnings and margins because they're so good, and we're going to talk more about them on the next slide. So I want to talk to the counterbalance of that really quick on the bear side, and that's the S&P 500 tech sector's valuations at a price to earnings ratio of 30.7. So PE is just a crude measure of valuation, right? So typically the higher the number, the more valued the stock, or higher overpriced the stock is, and the lower the number, the more undervalued. But you really have to look at more than that. But that's the general understanding. And so you would look at this and think, well, gee, that's really high. But Tim is going to explain to us why, when you look at the earnings and the earnings growth, this number doesn't look as scary as it does on just looking at a 31.7x number. So on that surface, 31.7 looks kind of scary. What's under the hood on the other side, on the bull factors that Tim's going to go into now, are the earnings and margins.
Yeah, I'll take the trifecta on the bull side. I'm going to actually hit the corporate earnings, like Joe mentioned, the net profit margins, and I'm going to relate it a little bit to the real GDP growth, because 2.1% GDP growth is good. It's expansionary. But when you look at corporate earnings growth growing at 23%, and you think about GDP being the value of all goods and services produced in the U.S. Annualized for that quarter, you think to yourself, wow, shouldn't GDP maybe be a little bit higher? And the answer to that is that the reason it's not is because net profit margins are basically growing faster than top line revenue growth. And we see that in the S&P 500. And it's that margin expansion itself that is basically supporting that 31.7 times valuation multiple that Joe mentioned. So we are expecting, again, solid corporate earnings growth. We are expecting record level net profit margins at 14.2%, all of which continuing to drive that real GDP growth. And we're going to talk a lot more about it here in just a minute.
Yeah. So I guess I'll stay on the bearish side. I'll go down to the AAII investor sentiment survey. It's bullish. So, I mean, it's bearish. I'm sorry. It's kind of funny. We just had one of the best quarters ever with indexes hitting all-time highs and returning all-time performances, right, around the world. Yet the sentiment is bearish, right? And so it is kind of a cross up here with people are not euphoric. This is not a market where people are euphoric and are jumping in and are really excited about it. People are participating reluctantly still. We talked about this last quarter. So it is very interesting that we have a bearish reading from the tummy test, right, from the sentiment, yet we had our best quarter. And so that is something to pay attention to, right? It is a conundrum there that people aren't feeling a little bit more euphoric about this market. But we know why. There's the new Fed, there is the war, there is inflation, there's coming off COVID still, there's, that's still in people's memory. So we can understand it, but it is interesting that we don't have if I said we just had the best quarter in recent history, you'd think people would be pretty excited about that. So that is a bearish sentiment sector. It's not probably preventing the market from going higher, and it is a retail signal, but it is an interesting factor, and it is on the bear side for this quarter.
All right, I'll just take quickly just unemployment and then the volatility and the geopolitics. Really, we talked about this last quarter. The market continues to price through the Iran war conflict. We're seeing that again. I mean, the VIX is a little bit elevated here since we've effectively restarted the war with Iran. But relative to prior conflicts, this remains very, very calm, if you will, given everything that's going on in the world. And the labor markets, again, with an unemployment rate of 4.2%, very stable unemployment, and actually drifted lower over Q2. So those were all bull factors for us at the end of Q2.
Tim, unemployment's always, it's one of the mandates of the Fed. It's always in the news. It's, it's one of the popular headline events that everyone talks about. But, from your research, our team's research, you want to talk about how the level of unemployment really doesn't matter. It's more of that rate of change and maybe what the Saul rule and kind of what we really look at there. Is that worth mentioning for a second?
Yeah, I mean, the rate of change, what we like to do when you look at unemployment and you look at that relative to, whether we're going to have a recession and really what it takes to get a recession, we like to look at like the 1 year rate of change on the unemployment itself. And, when we get that, driving towards 1%, then we start really getting into, the recession risk rising. And there's a lot of strategists out there utilize that same measure. So we look at the U3, we look at the U6. You basically see a headline unemployment rate, but there's so many constructs to unemployment when you lift the hood. And we tend to look at all of those and factor those in. So what we report on the main headline number, which is the U6 number, and that's what you're seeing in the 4.2% rate.
Yeah, I like that because it's really not the number itself, but the rate of change. Is that number going up or down faster? Exactly. Is what we look at. Not just if it's at 10%, we get a recession, or if it's at 3%. It's where did that come from, right?
It's the rate of change. It really is the rate of change. Yeah. When you hit that 1%, you've really got a recessionary risk at that point.
So if it was if it went from three, which is low, to 4, which is low, that is more concerning than
yes.
the 3 or 4 number.
Yes, absolutely. Yeah, and that particular indicator has successfully predicted, I'm going to say, each of the last 11 recessions based on
it is. 100% accuracy.
Yeah, it's 100% accurate.
100% accurate, which is hard to get. Yeah.
And we actually touched on what did we get to, Joe, just recently? I think we were at like 0.5 or 0.6, and then we had a reversal. Interestingly enough, historically, once you breach the 0.5 increase on the U6 rate, it's really never come back. This was literally the first time, I believe, in the prior 11 recessions we had, where we actually had a reversal.
It had an about
trigger recession. Yeah. Normally, once you get over 0.5, 0.6, it keeps going and you have a recession.
Yeah. That momentum keeps it up. It gets over the 1% and it comes. But we did avoid that this time. There was that soft landing or no landing that people have been talking about. So, the Fed rates over there on the bull side, we came into the year hoping to look for a cut. Now it's kind of, should we actually have a rate increase? And I think that's an interest. And we can spend a lot of time here. I'll just give a couple points on it, and Tim might want to make a comment. So on one side, the Fed has to fight inflation, or they're wanting to keep that low, and so they could raise rates there. And so the market doesn't really like rates going up because it's an adverse effect to valuations. But then we also have, why should the Fed raise rates in a normal cycle? And it's because economic activity is getting overheated, right? And so you have to look at that side of the equation as well, not just the unemployment. And so, this is where good news is bad news. The economy is doing really well. It's growing. The Fed has to cool it off, so they raise rates to reduce the level of economic activity. But here, with real GDP in the 2% range, it's not really getting overheated. So it might be more isolated to that unemployment, or to that inflation, which again is kind of a noisy number right now because of the Iran conflict and inflation going up and coming back down. So the Fed is kind of in a hard spot of knowing what to do, because when they push and pull on these levers, they do different things for different purposes. So it is interesting. There's a lot more there. We won't go into it because it is complex. But, as the headline reads, the market is expecting, a rate increase. Although I think that probability actually came down today from, under 17%. It was, I think, maybe over 40 earlier in the week.
Yeah,
I think it came down to about 17%. And that's because inflation, again, Reid came in, I think it was yesterday, it came in much better than expected. And so that might have put the brakes on, again, that rate increase. So again, it's a bouncing ball. There's that consolidate. We don't know. And so the market may kind of stay in this consolidation range as we try to figure it out. So.
Yeah.
Well, did we get everything there? I think we got pretty
so.
much. We beat that slide up pretty good. Yeah. So this slide kind of sums it up to 5 factors. And if you want to just try to understand the market at a very high level, there's really only 4 main drivers with a 5th consideration. So you have inflation, interest rates, corporate earnings in the Fed, and then geopolitical events. So if inflation is going up, that's more of a bearish signal. If it's going down, it's a positive. If interest rates are going up, it's bearish. If interest rates are going down, that is bullish. And so you see both of those are bear right now, okay? But if I could only have one bull on this page, it would be corporate earnings. And those, as Tim talked about, those corporate earnings are very strong. They're really the main driver of economic activity and profitability. And so we're very happy to see that bull. The Fed, if the Fed is putting money into the economy and it's very accommodative, that's usually, a bullish factor, meaning the market likes it and may go up. And if the Fed is taking money out of the economy or being restrictive with interest rates and the interest that they pay to banks and all the different tools that they have to control the economy, that's typically a restrictive bear, meaning that the market doesn't like that. And so right now, again, we're kind of on hold. We talked about that a little bit in the last slide. It's at 3.75. And we'll just kind of have to wait and see. And then the one that really surprises me the most here is just how resilient the market's been on the geopolitical events. Again, typically, if there's a lot of, wars and Ebolas and COVIDs and events going on, the market is very upset about. That's very volatile, and you'll see a bearish signal. Here, we're seeing a pretty calm global market right now, even though there's still these conflicts. Again, I was speaking last night to a couple hundred people and I was talking about the point of diminishing returns in the news cycles. You know, when a news cycle hits, when a war hits, or whatever the event, the shocking event is, people are talking about it 24/7. It's on every news cycle, and it's the talk of the town. And then, you know, about a month in, about a third of the people stop paying attention. And then another month in or so, another third of the people stop paying attention. And then, you know, eventually there's only a few people paying attention to it. So it just kind of loses its effect. And so I was talking about this last night, and somebody pointed out that there's still a Ukraine-Russian war going on, but no one really remembers it. But it's still there. It's still going on. But the markets have moved past it. And so we've seen this kind of ebb and flow start again and stop again with Iran, right? In the beginning, it was very sensitive to the markets. And now the markets are kind of digesting that. They see what's going on. And I'm not saying they have it right, but it's not creating as much volatility that's manifested in the VIX as you might expect when you read the headlines. So there is a news story is not as important, or is not as effective right now than as it was, you know, in the beginning of that conflict. The other thing I think we talk about when we talk about VIX, and which is 16, which is historically low, we're not just again looking at that number, we're looking at where that number is going. And so if the VIX goes from 16 up to about 25, the market's going to pull back, right? But when it gets to 40, we actually get very excited again, because when it hits the 40, it usually about faces, has that mean reversion trade, and comes screaming back down. And so we have to not only look and see what the level of volatility is, where it's coming from, where we're at in the news cycle, but where it's going. And so right now, again, that rate of change is pretty stable. And Tim always likes to look at statistics, right? Because we're managed by facts and figures and the preponderance of the evidence. And so he'll look and say, well, are we 1 or 2 standard deviation points above the mean? Are we 1 or 2 standard deviation points below the mean? And so we really look again at that rate of change. And right now, and Tim, you might want to add some points to this kind of geopolitical calmness that we're having. But right now, it's pretty stable. Which is interesting.
Yeah, it's very stable, historically low, if you will.
Right. So, it's below its average, right?
Yeah.
And right in the middle of, if you looked at the news cycle, and if you looked at that, the bearish sentiment that we showed you prior, you would think that the volatility would be at least at average, if not a deviation point above average, indicating an elevated level over normal. It's below normal right now. So
and right alongside of that, like we look at, you know, the put call spreads, we look at everything, and we look at, you know, what that put call ratio looks like, and puts and calls are, you know, what you buy for protection. You buy puts if you want to get more aggressive, you can lever up with calls. But a put is basically an option to sell your securities. So when, you know, at a certain price on a certain date. And it's an option, right? You don't have to exercise it. But if the market were to fall apart and you had that option or that put contract, you could theoretically cover some losses, whatever you decided to exercise at. Now, the interesting thing is that when you look at that metric relative to the VIX as well, we are sitting at record low levels of put call ratio as well. So again, very calm relative to where we're at.
Yeah, and on that ratio, just it's what we call it's a hedge, right? So that what Tim just described is what most of you are familiar with a hedge. So if you're worried about something going down, you hedge it so that you can protect or make money on the downside. And so what he's saying here is that there's not a lot of hedging going on the S&P 500.
Exactly.
So very interesting. All right, I think we beat that one up pretty good too, Tim.
Yeah.
You know?
Yeah. Good.
Oh, I'll let you start with this one.
My favorite one.
Yeah. Yeah.
All right, so let's talk about this relative to gold too, and you know, the dollar and some other things too. This is kind of a fun one. This is just a market cycle factor spotlight. This is one of the 4 factors that Joe was talking about, like drives the market cycle. And then so basically what we had take place during the second quarter was the entire yield curve. And when we speak of the yield curve, all we're talking about are just the different maturities across the U.S. Treasury curve, right? So you'll see 1 month, 3 month, 6 month, The further out the curve you go, the further, the more investors require, because we have unknowns as far as rate policy. They want to be compensated higher, so those rates get bid up higher. The fact that if you were to draw a line across the tops of those bars, the line would be upward sloping, and this is very healthy, right? This is a very healthy, what we call positively sloped treasury yield curve. The reason this is healthy is it's predominantly healthy for our banks, right? They tend to lend at the long end of the curve, right? 10, 20, 30 years, and they tend to pay out on the shorter end of the curve via deposits. And so banks tend to make more money the steeper the yield curve, which is obviously good for the economy. So we did have 2 events that actually triggered that yield curve to rise across all maturities in Q2. And obviously the first was the Iran war. And then obviously the second was we had that inflation resurgence, which triggered the new Fed chair to kind of give us what we call a hawkish pivot. And when a Fed chair decides to get hawkish, that means they're wanting to effectively cool the economy down with the threat of a rate hike. And obviously that is being done to manage inflation, while at the same time, right, the Fed maintaining that dual mandate, keeping an eye on what's going on with employment. So they're obviously walking a fine line. They don't want to kill our growth, but they want to make sure that inflation remains, subdued. I have a note there at the bottom. We continue to beat the drum on how nice it would be to see a durable resolution in Iran. And when we speak of a durable resolution, we're talking about a ceasefire that is, something that both sides really agree to and that actually is committed to, and ultimately resolves the issue between the United States and Iran. This would be a very powerful catalyst, not only for a treasury rally. And when we talk about treasury rallies, what we're talking about is people rushing in to basically buy U.S. treasuries, therefore driving yields down, which drives interest rates down, which is going to be good for the stock market, good for the economy. It would be very stimulative. So it's not only good for a rally in the treasury market, but it would also trigger a rally in the stock market. Some points. Go ahead, Joe.
Oh yeah, I just want to want to throw in there because the first line says inflation risk driven by oil prices. And so when we're talking about the Iran conflict right now, we're talking about oil in the Strait of Hormuz, and we're talking about inflation. And so because of the fear of inflation, those yields are going up, right? If we had a flight to quality and everyone was worried and they wanted to buy the bonds, then we get the opposite effect. So a crisis like this, bonds can go either way. If they're worried about a flight to quality, they're going to go buy a lot more bonds. Prices are going to be going up, yields going down. If the market's more worried about the inflationary factor, then yields are going to go the opposite direction. And that's what we saw here. So that's why when we say Iran, we're really talking when it comes to bonds about the fear of inflation embedded in those oil prices.
Yeah. All right. So again, 10-year treasury yields. Oh, we can, just very briefly, again, rising from 4.30 in early April to 4.47. And that was predominantly driven by the energy inflation fears. And it was that energy inflation that obviously triggered the new Fed chair to spark that hawkish pivot. With regard to all the spreads, again, 210 spreads, positively sloping. We've got investment grade credit spreads. We talked about the high yield spreads, tighter overall, but again, mentioning that triple C rated spreads widening to that 960 basis points. And that's, again, just looking at the weakest borrowers being repriced. Again, that canary in the coal mine, we keep an eye on that. But all in all, credit markets healthy, and the Bloomberg U.S. Aggregate Bond Index for Q2 returning a healthy 0.6%. So it was a little bit volatile, but we more or less broke even on the quarter. So, yeah. We can go to the next slide. There you go.
I think we might have hit most of these pretty well. I think we got oil, we got growth.
I
I
think
don't
we do.
know. Yeah, I think we can move on. I don't think I have anything else to comment there. Um, the next kind of slides that we're going to go through here are, if you want to advance the slides there, Julia. um, there's a lot of moving parts here. These are put out by JP Morgan's team, which is does a great job with charts. But again, there's a lot of moving parts. So we're just going to try to highlight some of the more important pieces of these. Here, what I will start off with is if you look at the top left box where you see the share of nominal GDP, normally the consumer, that's you, me, going out and buying Coke and Starbucks and Costco, we make up about 70% or here 68% of what goes into GDP. And then you see that the business fixed income makes up 13, government spending's 19, residential, and then net exports with imports. But if you look at the long-term averages, you can see that in Q1, that consumption was only contributing 0.4% compared to its long-term average of 1.7. You can see that government spending was 0.7 compared to 0.2. It's a lot of defense spending. And then business fixed income, which Tim talked about in that AI, was on average at 0.4 and was extremely high at 1.4. So this last quarter, although we ended up with a 2.1% GDP growth, which is pretty average, and we can grow at that for a long time, where that GDP came from, we saw some significant changes from that. Tim, you want to add some color to that, or?
Yeah, I would just say that the big takeaway in just looking at that box that's shaded all the way to the right, that 2.1% was the total GDP for the quarter. And the consumption part, which Joe referred to as you and I kind of going to Starbucks and just buying everyday goods and services, that fell from 1.7% to 0.4%. So it was really that AI CapEx type investment rising from 0.4 to 1.4 that helped buoy the economy, right? That and the government spending ticking up from 0.2 to 0.7. So we really have a trifecta of three things supporting the economy. The consumer, which is a smaller portion than normal, the largest portion now being the fixed investment by businesses, and that's normally like capital equipment type expenditures, and obviously government spending.
As I'm sitting here processing this, as we look at the AAII investor sentiment being bearish, when consumers are bearish, they usually are tighter with their pocketbooks. They don't spend as much. And so you can kind of see that manifesting itself here, maybe, where they normally are spending at 1.7%. We kind of knock that down. So there might be some correlation between the way the consumer is feeling and with where they're spending their wallet. So there is some correlation there, and definitely correlation with how companies are spending for the future. I think, again, one thing on CapEx that people need to remember, Tim, is that CapEx is really an investment. So if you see all of this CapEx being spent, companies are doing that in anticipation of future returns. And so that is a very, very bright future for the market. If they actually get a return on all of this spending, that's really setting up 2027 in the future to have some pretty good returns when they start realizing some profits on the investments that they're doing. Again, this business spending isn't just a wasted asset. It's going into a positive asset that will return a return on asset, right? A return on invested capital. So this is really the dam breaking. This is really looking to be good for the markets for the years to come.
Absolutely. Yep.
All right.
I can take this one, Joe, if you want.
Yeah, go for this one. I don't like this slide, but there's so much going on. But
I don't like it because it's busy, but I do like it for one thing. And if you just focus on the gray shaded box to the right of the slide, the key takeaway here is that energy has been the predominant driver of the latest increase in inflation. And the good news, if there is any, is that it has not yet trickled through to like core goods, and it's just now starting to rear its head in the dining, recreation, and other services category. Okay. So we haven't seen inflation yet become entrenched or spread really to other categories like we did in 2022. And you can see the orange and the blue, the light blue area, and even, shelter was not really, it was a huge factor back then, but I'm predominantly speaking right now to core goods and dining because that's where it would show up first. You can see how wide those bars got. And we're just not seeing that now. So we've got a really good opportunity to, get this Iran conflict wrapped up, get energy prices down, which we've seen, which will hopefully continue to drive those energy costs down. So that's really the main takeaway of this slide, that we're in pretty good shape. We can go to the next slide. This one here is a slide that I love. It's super busy, but we only, again, want to pay attention to that single bar that's highlighted right there, and that's that 26 earnings growth estimate of 24%. And this is something that we've been referring to, the fact that margin growth is now kind of outpacing revenue growth. You can see in the box up in the upper left, the average margin contribution to EPS growth historically from 2001 to 2025 was basically half of revenue growth. So 2.4% margin growth. Revenue growth has traditionally been around 5%. And you can see that the average EPS growth for the S&P 500 over that time frame is about 7.6%. In 2026, we have 13.7% margin contribution to that 24% earnings growth number and 10.9% revenue growth. And when we start thinking about why we have these, everybody says, oh, the market's expensive. Oh, and, we talked about the tech sector trading at a 31.7 forward multiple. We come back to this margin expansion concept, and you can actually see the profit margin on the right side there, that line chart at record highs. That's really what's driving valuations. And the key factor going forward that the Synergy team is really honed in on each earnings season is whether or not that profit margin is sustainable, right? If anything, we just need it to flatten out. We don't even need it to continue to rise like it's been doing.
Yeah.
Even if it just flattens out, that'll be healthy, right? We can sustain that. What we don't want to see is a margin decline, because once we start having margin compressions, then we start getting valuation compressions. The stock market get really volatile, and we could see some declines take place across all the sectors. So we are keeping a very, very tight pulse on that. But this particular chart shows a really, really nice dissection of what is driving the earnings growth for 2026, and it's super fascinating to look at those components. So we can go to the next slide. This is a slide I really like. We're just going to touch on each of the three different parts here very quick, and it speaks to the Mag 7. Let's focus on the big chart to the right. 2026 year to date has been really the first time in the past several years that we've seen a performance dispersion for the first 6 months of the year. And you can see that Microsoft, Meta, and Tesla, those are the ones that are basically performing below zero. And the only gainers were really Amazon, Google, Nvidia, and Apple. And that has translated, if you look to the upper left, the 26 year-to-date Mag 7 returns are effectively zero. And the interesting part of this is that the year-over-year earnings growth for the Mag 7, and that you can see in the lower left bar chart, is actually forecast to be 38%. So you wonder why. You ask yourself, why did the Mag 7 not perform when the year-over-year earnings growth is forecast to be 38%? And you can see the remainder of the S&P 493 clocking in at 19%, and the S&P was up, solidly for the quarter. What's going on? The real issue comes down to what Joe spoke of earlier, which was the CapEx. And that stands for capital expenditures. And investors are now concerned that, as Joe was mentioning, that CapEx, there may not be as high a return on investment as originally thought, because of the amount of CapEx basically being invested, right? So now investors are starting to question whether or not there's really going to be a return on that investment, or what that return is going to look like. Our belief is that this really does set up the Mag 7 and specifically the hyperscalers for more of a rebound towards the second half of the year. If we go to the next slide, we can see another segment within technology that's been hit on the chin recently, and that's software. So if you look to the left, you can see the hyperscalers that I just referred to. This is the AI-related industry performance, and you can see that the semiconductors have basically led hyperscalers, and this is when you see the percentages up there. This is the industry percent of the S&P 500. But when you look at the chart, the bar chart that shows the highlighted red where it's -5%, that's the actual performance of the hyperscalers themselves. And again, that's speaking to the CapEx component. When you look at the software side, you can see software down 20%. And again, there's a concern here that AI might actually cannibalize some of this software industry. So we've seen, all the companies from, ServiceNow, even Microsoft, Intuit, ADP, Paychex. It really is a wide swath of the technology software industry getting hit over concerns that not only is AI going to potentially cannibalize their business model, but what we saw with IBM when they reported or pre-announced yesterday was our real first indication that companies are now prioritizing their CapEx and AI spend away from software to more of the hardware. In other words, the chips, networking equipment, switches, stuff like that. And that's why the software industry has been down. Okay, even though if you look to the right, you can see earnings growth still forecast to be 19% for software. So given the results of IBM and the statements that came out from the IBM, the president and CEO yesterday about how they were surprised at their customers reprioritizing their spend, we're expecting over the next several weeks, as these companies begin to report and guide, that if other software companies are starting to experience what IBM has already experienced, that perhaps that earnings growth forecast will in fact come down, validating the software weakness that we've seen in terms of performance over the past 12 months. And again, we saw that really just for the first time with IBM. So hyperscaler earnings growth is still forecast to be really, really strong. And that's why we're kind of calling for more of a recovery in that portion of the AI related industry. So
like Wayne Gretzky always said, right? You got to go to where you got to skate to where the puck's going, not to where the puck was. So
exactly.
All right. So we're pushing almost an hour and a half here. We'll try to get this wrapped up here in the next 6 minutes. So
yeah, we can hit the next job. I'll let you take it from here. Here's your favorite. Here's your new slide.
Yeah, well, this is just showing the quarter over quarter change in each of these sectors. So I'll go through real quick. You can see, for the most part, technology industries are up, utilities are modestly improving, and then you can see the downer. So that's pretty self-explanatory. You guys can read this when you get your copies or blow this up. So for the interest of time, we'll go ahead and move on here. We could spend a whole day on that slide as well. But here, I think this is a good outlook and positioning. What we're watching, we're going to obviously continue to watch the Iran ceasefire in the Strait of Hormuz. Earnings we've talked a lot about started yesterday. The Fed policy, we've talked a lot about the hyperscaler. So these things are just a summary of what we're going to be looking at. We're going to overweight equities right now because of the evidence that we have. It doesn't mean that we think they're going to straight up, like Tim said. Between now and the midterms, we're consolidating. We could have a 10 or 15% pullback. That's not out of the question, but we still are looking at equities. Again, when you look at equities and risk on assets, you have to think about your time horizon. So if you're worried about needing your money over the next 3 to 5 months, you shouldn't be in equities, right? But if you're looking at 3, 5, 10 years, then you're going to want to have that equity exposure at on the upper end of your tolerance. And so again, everyone has a tolerance. Maybe one person wants 50% equities, the max that they would have in their investment policy statement. Well, what we're saying right now then is you could be at the upper end of that, of your comfort zone. Energy, again, so much going on. We're kind of neutral on that. We just have to wait and see. Short-term rates, again, we're neutral on. We're underweighting long-term. We wouldn't be going out and buying a lot of long 30-year treasury bonds right now. because of the potential for rates to go up. I mean, bond prices to go down. And so there's some risk there that we would be avoiding. International, again, it's run really well. There's still valuations are cheap, but the dollar strength is strong, and the emerging markets have already rallied so well. So we're not saying avoid them, but we're just neutral on that. And then cash is still paying investors a decent return, and we're kind of neutral on that as an asset class level. So that kind of summarizes the positioning or posturing across those asset classes. On the next slide, you can see here, again, I think we've probably gone over most of this. Tim, you want to just touch real quick on what this means to the investors?
So risk on positioning paid off. We reviewed the sectors that performed well. Investors that had risk on posturing entering Q2 were rewarded. And this really kind of speaks to the behavioral finance aspect of what we do in our CIO capacity and working with our advisors. The key is to remain invested. Don't panic. Hold a lot of cash. Hold whatever amount of cash takes to be comfortable. Rotation risk is real. It does happen, and we saw that. In this case, diversification was rewarded because the Mag 7, it didn't really perform much the first half of the year. Right, half the Mag 7 was up, the other half of the Mag 7 was down. The fixed income continues to offer a ballast, right? But as Joe mentioned, go ahead.
Oh yeah, let me just add something on the Meg 7 on the rotation here, because I think sometimes people watch these and they think, oh my gosh, you gave us all this information. What are we supposed to do? You don't have to do anything, right? This is just some information. But an example is we're not going to give up on some of the world's greatest companies, these magnificent 7. They're going to come in and out of favor. We're not trying to time the market. And in 2022, when the Meg 7 were hit, you heard me talking about we're holding. I'm not going to sell Microsoft and Meta and stuff just because they're down. Remember, Buffett said that you should never buy or sell a stock based on price movement alone. So as these companies rotate, we're not saying you should just abandon them or rotate out. We're just saying that they're in or out of favor. So we're going to maintain. We want to own the best companies in the world with the best management, who are the best allocators of capital. And unless those fundamentals change, just because price goes in or out, or they come in or out of favor, isn't going to necessarily make us abandon the world's best. So sometimes I think when we talk about rotation, I don't want advisors to think that, oh my gosh, we have to sell everything and then buy everything back. We're just kind of showing you where the return attribution's coming from. So just we love these world-class companies, and they're going to be leaders. You just have to be patient.
Yeah. And then regarding the fixed income, obviously that diversification continues to persist. It's fixed income investors are rewarded, but again, the long end of the curve, we're underweight on that duration risk, what we call the duration risk for the long end of the curve, because of the threat of interest rates continuing to rise. We're just not in favor of that at this point.
Yeah, and a point to note here on our focused individual bond portfolio, again, we like the individual bonds. We would be not as excited about bond mutual funds or ETFs. But when we hold our individual bonds, we can hold those to maturity. And so that fixed income, even though we're going to see rates come up, it still can play a very nice place in a portfolio when you're using individual bonds. So
yeah, absolutely.
Don't be scared of the fixed income, that the way that we're managing it. We think that it still has a meaningful purpose in portfolios.
Yeah, and cash, just keep in mind too that cash and short-term duration bonds, those are real returns still. We're still seeing short-term treasury yields and money markets 3.5%, 4% annualized. So that's closely tracking the Fed funds rate of 3.75. And in this environment, the opportunity cost of holding cash remains low. So patience continues to have a real environment, or real value in this environment. We did the research on this last point, and history does favor a recovery from here. Again, we had a really, really rough start to the year, and Q2 ended up being the best quarter we've had since 2020. So when we go back and we look at the trends and study this, it looks as though that history will suggest that when you have what we call a top type Q2 quarter in terms of performance, that further gains are most likely rather than reversals, and especially since we're probably going to have a little bit more volatility here through the midterms, and again that same trend through midterms suggests gains after the midterm. So that's what we're expecting. We'll see what happens.
Yeah, you're right.
Yeah. And we can go to the next slide.
I think on this, in the interest of time, I think the SAM view is probably pretty well expressed right now. Risk on with some hedges, bull market regime, and an economic expansion with a little bit of volatility in the middle between the midterms. Patience and discipline are still the edge, right? We still need to maintain that. That's what's going to get you through, not market timing. Q2 earnings season is starting. We're really paying attention to that, and we think it'll be okay. And then remaining cautiously optimistic for the end of the year is where we're at. Again, you can read the bull and bear. We always like to kind of be fair and balanced, right? We want to go, well, it could go up, it could go down, and what do we think? And so we do present those, but again, in interest of time here at an hour and a half, I think we'll move on to the next slide here. So what should you guys be doing, right? Clients should be holding enough cash to stay comfortable, like Tim said, right? Always evaluating your investment time horizon, your investment policy statements, making sure clients are communicating and that we're listening to clients. For those advisors, right, that are working with retail clients, they need to make sure that their clients are communicating any changes so that we can give you guidance on readjusting the portfolios. And of course, we need to help retail clients understand to be patient and just don't let that sentiment and that tummy test help them make ad hoc revisions in the wrong direction. What are we going to do? We're going to continue to listen and adjust as necessary. We're going to continue to manage via a data-driven process. As you know, we continue to monitor and adjust continuously, and we'll communicate weekly and monthly and quarterly about what we're doing. And so we're very proactive about that. And we really want to thank everyone for staying on for so long. I know Tim and I, we could talk about this for days. As you can see, Tim is so knowledgeable and so passionate about this. Again, you give him a microphone, he will talk and educate you for hours and hours and hours. So at an hour and a half, we really appreciate you taking the time with us today. And we're here for any questions. And Tim, do you have any final thoughts that we should leave people with?
Oh, all good. Just stay invested and don't panic, and continue to work with your financial advisor.
There you go. Well, thank you very much. We really appreciate you guys. Have a wonderful day.
Thanks.